So, I want you to imagine pitching this massive, multi-billion-dollar project to Wall Street.
Oh,
You stand up in front of all these incredibly powerful investors, and you promise that this new initiative is, like, your absolute top priority. You tell them it's going to completely define the future of the company.
right, setting huge expectation.
Exactly. But then, just 3 months later, you step back up to that exact same microphone, and you refuse to even utter its name.
Yeah, which is terrifying for investors.
Totally. So today we are taking a deep dive into Northrop Grumman, the legacy defense giant. We're trying to figure out why they suddenly went dead silent on some of their most hyped aerospace programs.
And, welcome to the deep dive, by the way. What we're really doing today is a gap analysis.
Yeah, a gap analysis. Basically, taking the transcripts from their first quarter earnings call and their second quarter earnings call, putting them side by side, and just, well, analyzing the delta.
Right. We're looking at the prepared remarks, the analyst Q&A sessions, all the corporate PR.
Just trying to figure out the massive and honestly sometimes shocking difference between what management promises you in the spring and what they actually deliver in the summer.
It really is a masterclass in, reading the white space. When you analyze these side-by-side transcripts, the most crucial data point isn't always the shiny new revenue number.
No, definitely not.
Often, it's the strategic omission. It's what they deliberately choose not to say.
Okay, let's unpack this. Because looking at these two communications back to back, the glaring realization is that the biggest story here is entirely invisible.
It's completely gone.
Like back in April, Northrop Grumman's management was setting off absolute fireworks around the Navy's FAXX program. That's the highly classified next-generation fighter jet.
Right. They called it a top priority.
They boldly predicted a major award decision would happen in the third quarter, which is right now. And they explicitly instructed investors to, model this into their spreadsheets, promising major upside to sales and earnings.
But then you fast forward to the July call, and that entire narrative just vanishes.
Oof.
Literally zero mention in the prepared remarks by management. And zero questions from the financial analysts about the fighter jet.
Which is wild.
And it wasn't just the fighter jet. They completely dropped their unmanned collaborative combat aircraft, too.
Right, the CCAs. Or I think they're sometimes called the YFQ-48 or Talon.
Exactly. They're essentially these loyal wingman drones designed to fly alongside the manned fighters. In April, management spent all this time bragging about 500,000 flight hours of experience with this unmanned tech.
And in July,
Erased. The topic was just gone.
it's bizarre. I mean, it reminds me of a friend who won't stop talking about this high-stakes magical first date they're going on.
Oh, yeah, we all have that friend.
Right. They tell you the restaurant, the outfit, how this person might literally be the one, and then you see them the next day and you're like, hey, how did it go?
And they just stare at you blankly.
Yeah. They just stare and start talking about the weather. You know immediately something went horribly wrong.
That's a great way to put it.
But, in a corporate setting, is this sudden silence a definitive sign of a lost government contract? Or are we just seeing, a sudden veil of classified secrecy dropping over the program?
Well, what's fascinating here is the underlying mechanics of corporate public relations, especially in a heavily regulated environment like defense.
Right, they can't just say whatever they want.
Exactly. Earnings calls are meticulously engineered events. Every single syllable is vetted by general counsel, investor relations, the whole C-suite.
So it's not accidental.
Not at all. If the Navy had simply pushed the award decision back a few months, management would confidently state something like, we still anticipate a favorable decision. The timeline has just shifted to Q4.
Because giving bad news early is always better than letting Wall Street guess.
Precisely. That manages expectations. So, total erasure. That means the competitive reality has shifted so drastically that any comment they make would force them to either admit a severe setback or, risk legally misleading investors.
Wow. So dropping a previously hyped growth driver without offering a new timeline is basically a massive flashing neon sign that they aren't the front runner anymore.
Yeah, it's a huge red flag. And we also have to look at the other side of the table, the institutional financial analysts on the call.
Right, the people asking the questions at the end.
Exactly. They didn't ask a single question about the FAXX fighter either.
Which is crazy to me. If I was an investor, I'd be demanding answers.
Well, it actually suggests the broader market already knew the door was shut. Institutional analysts, they don't want to waste their limited Q&A time asking about dead ends.
Oh, I see. They reallocate their focus to where the money is actually flowing.
Exactly. Silence in this arena is an active, calculated signal.
Okay, so when management completely drops the narrative on future unwon fighter contracts. Nature abhors a vacuum, right?
Hmm.
The capital and the conversation have to flow somewhere else.
And it did. The conversation pivoted sharply to the past tense. They replaced all the empty promise of future wins with concrete, completed deliverables.
Yeah, looking at the transcript shift, the vocabulary flip is super striking.
Very much so.
In the spring, when they were discussing the Sentinel program, which, for those who don't know, is the military's massive, multi-decade upgrade to our nuclear ICBM deterrent management, used forward-looking hopeful phrases like, "we expect," or "we are working closely."
But by the summer, the language completely hardened.
Yeah, it became, "we completed acoustic testing and we achieved our milestones," or like, "we broke ground on a new Utah facility."
And they backed up that hardened language with undeniable math. The Sentinel program alone drove a $7.6 billion increase in the backlog.
Billion with a B. That is huge.
Right. And that pushed the company's record overall backlog to $105 billion. But honestly, perhaps the most critical metric they delivered was a quarterly book-to-bill ratio of 1.84 times.
Okay, wait. Let's pause and translate that for someone who, isn't spending their weekends reading defense sector balance sheets.
Fair enough.
What is the actual mechanism behind a 1.84 book-to-bill ratio, and why does Wall Street care so much?
So book-to-bill is basically a metric of future revenue visibility. For every single dollar of revenue Northrop Grumman actually recognized and billed in that quarter, they booked or brought in $1.84 in brand new orders.
Oh, okay. So a ratio of 1.0 means your business is just flat. You're replacing what you finished.
Exactly. Anything over 1.0 means you are actively growing. So hitting 1.84 is staggering for a legacy prime contractor.
That's almost double.
Right. It gives investors deep psychological comfort, because it practically guarantees the assembly lines will be running hot for years to come.
Which explains why they capitalized on this by raising their full-year sales guidance, right? Up to that range of $43.75 to $44.25 billion.
Exactly. They leveraged that momentum.
Here's where it gets really interesting to me. It's the psychological shift in the boardroom. This is the exact difference between pitching your startup to venture capitalists on a whiteboard, using dotted lines and hockey stick projections, versus sliding a fully audited, highly profitable balance sheet right across the table.
I love that analogy, because if we connect this to the bigger picture, what we are witnessing is the payoff of narrative debt.
Narrative debt, I like that.
Yeah, in April, the company was essentially borrowing investor patience against future expectations.
Just wait, it's going to be great.
Exactly. But by July, they paid that debt off with execution. Though we do have to look very closely at the mechanics of some of these wins, specifically in their solid rocket motor business.
Okay, right. The SRMs.
Management announced they completed qualification for the PASI-3. Those are the Patriot Advanced Capability Missile Interceptors.
Right.
And they highlighted a $2 billion framework agreement with a potential $10 billion opportunity over the next 7 years.
I mean, $10 million sounds like a massive victory you could take straight to the bank.
It is a massive headline. But, and this is big, but a framework agreement is just a handshake on the basic architecture of a deal.
It's not a signed check yet.
Not at all. It is not the final signature on a government check. The underlying mechanism that actually converts a framework into real revenue is a process called definitization.
It's definitization. It sounds like a word created in a Pentagon basement just to justify infinite meetings.
It pretty much is. It is the brutal, painstaking negotiation process where government actuaries and corporate lawyers lock themselves in a room to hammer out the exact pricing.
The fun stuff.
Right, the fee structures, the inflation protections for a multi-year build. It's exhausting. And CEO Kathy Warden was actually notably candid on the call about this.
What did she say?
She explicitly stated, and I quote, "Those negotiations are ahead of us."
Wow, okay.
So that $10 billion figure represents pipeline opportunity, not contracted, risk-protected revenue. The company still has to navigate the immense friction of converting that framework into an executed contract where they actually get paid.
Got it. So when a company pivots from future hype to past tense receipts like that, there's always a middle ground. What happens to the legacy programs that are, just chugging along but no longer serve as the shiny object for investors?
They experience a quiet deferment. They just get shuffled softly into the background of the earnings call. They shift from being strategic centerpieces to just mere operational arithmetic.
The B-21 stealth bomber feels like the perfect example of this.
Oh, absolutely.
Because in the first quarter, the B-21 was the absolute star of the show. Management was touting a $2.5 billion company-funded investment plan. They spent significant airtime defending the bomber's long-term return on investment.
But then you look at the second quarter transcript.
Exactly. It was downgraded to a single bullet point in a segment update. Management basically just repeated the exact same phrase from April, that they expect the Air Force to make a decision by year-end on accelerating production.
And the Golden Dome Layered Missile Defense Project suffered the exact same fate. It went from a grand strategic vision to just a quick operational update about scaling revenue.
So when management uses the exact same language in July that they used in April regarding an Air Force decision,
They are signaling that there is zero new information to digest. They deliberately turned the volume down to focus analysts on metrics that actually moved.
Okay, but I have to play devil's advocate here for a second.
Go for it.
The aeronautics segment, which houses the B-21, is driving 13% growth right now with a solid 10.3% margin rate.
Sure.
The numbers are actually improving. So is the B-21 program in any actual trouble? Or is this just a case of management getting bored of their own talking points and wanting to highlight new shiny things?
No, that raises an important question. And it's crucial to distinguish between a failing program and a reprioritized narrative.
Okay.
The underlying data for the B-21 actually shows health. Management simply realized they had already extracted all the near-term public relations value they could out of the bomber. So the downgrade was benign.
So no real panic there.
No. But the actual red flag in this section of the transcript, like the most critical corporate, centered entirely on free cash flow.
Yes. The mechanics of how they talked about their cash shifted dramatically between the two calls.
They really did. In April, management confidently promised they had a plan to, quote, offset the free cash flow impacts for the years 2027 and 2028.
And the word offset implies a completely solved equation.
Exactly. It tells Wall Street, we have a hole in the budget, but we know exactly which levers to pull to fill it.
But then in the July transcript, the chief financial officer walked that exact phrasing back. He stated they are going to continue to refine those numbers through the quarter and give an updated view later.
And that linguistic pivot from offset to refine is monumental in corporate finance.
Because it means they don't have the answer yet.
Precisely. When a CFO says they are refining future cash flow expectations without providing a concrete structural reason why, it reveals unquantified internal math. It is the financial equivalent of admitting the puzzle pieces are no longer fitting together on the spreadsheet, and they need another 3 months behind closed doors to try and make the numbers work before they commit to a hard target for Wall Street.
Man, that shaky cash flow math leads us directly to the darkest corners of the balance sheet.
It sure does.
This is where we find the projects actively bleeding money, and we get to see the rhetorical magic tricks management employs to quarantine them.
We are looking at the classic 2 EAC problem.
Okay, for the uninitiated, EAC stands for Estimate at Completion.
Right. It is the total expected cost of delivering a project from start to finish. In defense contracting, a negative EAC adjustment means your internal cost just spiked, and your expected profit margin basically just evaporated.
It's a massive cost overrun.
Exactly.
And Northrop Grumman was forced to explain 2 simultaneous overruns on this call. They took a hit on the GEM 63XL in their space segment, and another massive hit on the stand-in attack weapon, or SiAW in defense systems.
Right. And the SiAW overrun was so severe, it triggered this crazy cascade effect. It turned a completely separate missile program, the AAR-GEM-ER, into collateral damage.
Which sounds insane. How does one missile failing make a totally different missile fail?
Well, the mechanism behind that cascade effect is the integration lab.
Okay, collapse. That is wild. So what does this all mean for the executives who are trying to spin a multi-program traffic jam to ruthless investors?
They need a very deliberate PR strategy.
And their strategy here is brilliant, but honestly, it's wild. They completely isolated the bad programs, boxed them up, and then boasted that, hey, if you exclude those specific disasters, the rest of the defense systems and space segments ran at a beautiful 11% operating margin.
Right. Ignore the fire. Look at the fresh coat of paint.
It is exactly like me sitting in my doctor's office and arguing, hey, doc, if you completely exclude the 3 massive meat lovers pizzas I ate this weekend, my diet was absolutely perfect.
Yeah. And the doctor would tell you your arteries don't care about the hypothetical reality where the pizzas don't exist.
Exact.
But, in institutional finance, this is a highly sophisticated survival tactic. It's known as the isolate and reconstruct strategy.
Okay, how does that work?
Institutional analysts build massive, discounted cash flow models to value a company. By explicitly quantifying and quarantining the toxic asset, management allows the analyst to write off the cost overrun as a one-time anomaly.
Oh, so they can just scrub it from the spreadsheet.
Right. The analyst can then plug that healthy 11% margin back into their model for the core business, preserving the company's overall stock valuation.
Man, it provides the analysts the exact mathematical justification they need to keep a buy rating on the stock despite the bleeding.
Yep. But CEO Kathy Warden followed this up with a massive dose of reality. An analyst pushed really hard on whether the bleeding was actually over.
And what did she say?
Warden admitted that, quote, there is risk until the qualification testing is fully complete. And then she dropped an absolute bombshell into the transcript.
The independent resources comment.
Yes. She revealed that they brought in independent resources to scrub their assumptions behind that negative EAC.
Which is huge.
It is remarkably rare for a Fortune 500 chief executive to explicitly state on a recorded earnings call that they had to hire external independent auditors to check the internal math on a tactical weapons project.
Because it means their own math was totally wrong.
Exactly. The underlying mechanism of that statement is a tacit admission that the cost estimates generated by their own people in the previous quarter were deeply flawed.
So they're throwing their own estimators under the bus to save face with Wall Street.
Pretty much. By bringing in independent resources to stress test the math, management is signaling to Wall Street, hey, we know our internal projections failed last time, so we removed the bias. It is a calculated move to rebuild credibility by publicly owning a failure of internal process.
But when you are forced to discuss cost overruns and confess to bringing in outside tutors to check your math homework, you desperately need a distraction.
You really do. You have to change the channel.
You need to pull a rabbit out of a hat and show investors you still own the bleeding edge of the future.
Right.
And the transcript captures this highly orchestrated, almost theatrical moment right in the middle of the call. Out of nowhere, CEO Kathy Warden casually mentions that their mission robotic vehicle, the MRV, is launching into space later today, weather permitting.
Yeah, that timing wasn't an accident.
Not at all. It felt like a total Steve Jobs, oh, and one more thing moment, but executed by a legacy defense contractor.
Looked very flashy.
But crucially, she emphasized that this robotic space vehicle was built on a commercial model.
And using the phrase commercial model on a legacy defense call is incredibly strategic.
Why is that?
Well, traditional defense contracting operates on a cost-plus mechanism. The government tells the contractor exactly what to build, they pay for the years of research and development, and they guarantee a fixed profit margin on top.
So it's incredibly slow, heavily bureaucratic, and nearly risk-free for the company.
Exactly. The commercial model is the exact opposite of that. The company uses its own internal money to develop a product, takes on all the financial risk, and hopes to eventually sell it as a service.
Oh, wow. So they are desperately trying to signal to Wall Street that they can move fast and take commercial-style risks, like a Silicon Valley tech firm.
They have to adopt this commercial framing because they are terrified of being viewed as dinosaurs.
Especially with who they are competing against now.
Exactly. During the Q&A, an analyst brought up the massive space-based AMTI program, that's Airborne Moving Target Indication.
Right.
The vital context here is that SpaceX, a highly agile commercial competitor, just secured a $4 billion award in this exact space.
$4 billion.
Yeah. And when asked about it, Northrop's management vaguely acknowledged the capabilities were attractive, but disclosed zero concrete current bid position.
So when billions of dollars are flowing to aggressive, non-traditional commercial competitors like SpaceX,
And a legacy prime contractor says nothing concrete about their own strategy to capture that market.
the silence is the signal. Which brings us right back to where we started. To you listening right now, the ultimate takeaway here is that being truly well-informed isn't just about reading the text, it's about mastering the art of reading the gaps.
It's an incredibly useful skill.
I challenge you to apply this framework this week in your own life. In your next team meeting, a client pitch, or even a deep conversation with a partner, don't just analyze the talking points they are emphasizing.
Right.
Pay very close analytical attention to what quietly falls off the agenda. The things they suddenly stop talking about hold the real truth.
And, if we pull back the lens and look at the macro picture these transcripts paint, I want to leave you with a final thought to ponder.
Let's hear it.
We just watched a legacy defense giant desperately adopt Silicon Valley commercial models for space launches to prove they can move fast, We saw them forced to bring in independent external auditors because they could no longer trust their own internal cost estimates on tactical weapons.
Yeah, which is crazy.
So if the old bloated mechanisms of doing business are failing this publicly, are we quietly witnessing the absolute end of the traditional blank check era for defense contractors?
Man, that is a phenomenal question to leave hanging in the air. The next time someone makes you a massive promise, you better pay attention to what they don't say 3 months later. Thank you for taking this deep dive with us today. Keep questioning the narrative, keep looking for the gaps, and we will see you next time.